Okay, hello everyone. Thank you for just joining up for the fourth session of Supply and Demand Advanced Trading Concepts. Today we're going to cover a new material, which is a confirmation price action that is derived from the supply and demand order flow concept. For those who are not familiar with supply and demand yet, don't worry, we're going to do you a very fast recap since we are on the fourth session already in it. So let's start and dive in for what we are about to do today. So today we're going to um, work on a confirmation price action, which is based on order flow analysis. It's called a Quasimodo, but it's also known as a fake out or a false breakout or a different formation of head and shoulder. Some of you would find it familiar, but we will dive into the specification, the anatomy of what makes it a reversal price action confirmation. So it's similar to, although it's look like head and shoulder, we will learn how to specify this and find the differences from head and shoulder, and therefore we will know for greater probability that if that's a head and shoulder or Quasimodo confirmation. So let's dive in. So first, a little about myself. My name is Gil Ben-Hur. I'm trading for 14 years. I used to be an independent day trader. I was a portfolio manager for myself, members of my family, and private clientele for many years. I used to be a co-owner of a big trading community with a premium trading education program. I was doing education for many years. And since 2016, I've founded the 5percenters.com, which is a funding, Forex traders, and a growth program. So if you are a Forex trader and you are looking to be funded, check out our site and you see what are the terms, what are the requirements, and maybe you can fit in to join us trading our funds. So let's move on to what are we looking for when we are trading. Let's just start with a recap on supply and demand, and then we'll hop into the Quasimodo thing. Okay, so for those who are not familiar with supply and demand is a concept, reading method that will help us look at the charts, the naked charts, and try to tell the story of the market, the story that the participant in the story, the heroes of the stories, are two parties, two broad parties, buyers and sellers. Okay, the supply and demand is a concept which is a universal concept, a timeless trading concept, because every market, including the very simple market, whether it's vegetable or real estate or stock markets or very complex financial market, price movement is determined by the amount of supply or demand, by the amount of people willing to buy at a certain price versus people willing to sell at versus price. And that balance between buyers and sellers requests determine if price rise up. It's a very, very simple concept to comprehend. If there are more people willing to buy the asset, then price will move up. If more people are willing to sell the product, then there are buyers, price will move down. When price is ranging at a certain range, that tells us that there are enough buyers and sellers to agree on price and quantity, and they are satisfied, and therefore price is ranging, staying at the same price unchanged. Okay, so we have in supply and demand three different states. One is base, where price is ranging. We call it basing. And the other one is rally, where price is driving up, where there are more buyers than willing sellers. And there's another state which is a drop, where there are more sellers than buyers. Very, very obvious. So what can we tell about this? The concept of supply and demand or order flow analysis is very, very simple. We see whatever happened in the past, and that will help us to determine where can we find willing sellers or willing buyers in a future price. And this is where we want to buy or sell. For instance, let's just simplify everything and then we go into more specific technicals. If we see that price is dropping here, we okay, you're right. Sorry, I have to change to this. Okay. Now you all see my chart? Okay. So again, what we're looking for in a chart is the story that tells us the buyers versus the sellers. We want to read the narrative for the balance power events by the buyers and sellers and participants in this story. Okay, in this specific tradable asset, which is the euro versus the British pound, we are looking at different places and prices where buyers exceeded sellers and sellers exceeded buyers, and so on. Supply and demand is a theory where we are looking at these events that had happened in the past, and we are waiting at specific price to buy or to sell from a specific price, where we can assume with greater certainty that there are waiting buyers and sellers. And the simple concept tells us that where we see a big drop or a big rally, the region where it started, this is where we assume there are waiting buyers, and for the drop, this is where we assume there are willing sellers. Why that assumption? Let me prove to you that assumption. Because just imagine what happened at the desk of the exchange. Let's say 100 people are willing to buy euro versus the pound at this price of 0.9092. Okay, they are willing to buy here, and some of them get filled by this rate. Let me just make it zoom in for a while. Okay, at this rate, all that basing area is where people were satisfied. The buyers were receiving their euros paid by the pound, and they were receiving this at approximately 90 rate, okay? And then suddenly price starting rising up very, very hard. What had happened here? At this specific moment, there are no more sellers. Therefore, the exchange could not find a matching orders from sellers to satisfy buyers. What it tells us that at this very specific price, where we see price is rising up, that there are probably, we can assume that there are unfilled buyers that were willing to buy, but there were no sellers. So what happened? Prices rise up until they find more sellers. And through all this rally, it was very hard to find enough sellers to stop price. And price, every time it finds sellers, it continued to go up and break more and more higher levels. So at the origin of this pole, we assume we can find a big chunk of buyers willing to buy at this specific price. So let's see what happened once price had gone to that place. Look how precise price is reacting to this very specific price that we've marked right here on the decision point. This is what we call it. So this is the very concept of supply demand. If price had decided to shift to a new price levels, then at that decision for price to move on, this is where we assume we will find the resistance from the buyer side. So we call this area, we call it a demand zone. Okay, demand zone is being plotted, being drawn like this. From the decision point to the lower swing, that will be the demand zone. And then we stretch it all the way to the future and wait for price to come. And once price do come, we see how precise the reaction is. It's not yet a reversal, it's just a reaction, okay? So this is a demand zone. And what does the demand zone tells us? It's also give us the almost 80% of our trade plan within just drawing a simple rectangle. We have the entry price where we are going to buy by limits order, and we have just below the swing, we will place our stop loss. So we already have our entry and stop loss predetermined before price had made it to there. And in that instance, it had given us, we're looking at M15, okay? So it was giving us 25 pips reaction with 0 drawdowns. See how precise is this zone. And if we look furthermore, we see this zone was not fully consumed before it gave a higher reaction of 75 pips. Okay, so we can see for sure that at this area we have waiting buyers resistance, and that we can take advantage in the future. Same thing applies on the seller side. And this is what we call the supply. Okay, so we see price is rising up. There is a decision to go down. We can see this with the naked eye. Very, very simple. And so we have the decision point where price is going down, and then we have the swing high, and see what happened when price gets for the first time into a first supply. It climbs all the way up, and then it gives almost 8 pips inside and gives a 34 pips reaction before it continues. And so this is how we mark supply and demand. So we have entry right here, and above the swing, we have our stop loss for the short, and then we have 34 pips as reaction. See how simple it is, and it's not yet a reversal, okay? It's just a reaction. So the supply and demand, the order flow theory, tells us where we are about to find a good resistance within the charts. So this is why we're reading it, and it's that simple. This is all it got for the supply and in terms of the theory. So now price in for the euro pound is approaching a new supply, first supply right here. It's an H1 supply, okay? We're on an hourly chart. So I would say that would be the decision point right here. So with that, if we were about to sell, so we would create a limit order right on the decision point level, and our stop loss will drag and drop. Our stop loss will be just above the swing high of that zone, okay? So we are going to risk about 18, 17 pips, hoping for a reaction as much as 17 pips, let's say 1 to 1. Okay, so that can be, let's, during this session, maybe we'll see the reaction very, very soon. Let's see. It's about to be triggered, and so we'll see how it works. Supply and demand also have no time zone. It's not a time zone type of concept, because it's all about price. Price is being rejected or being or meeting resistance wherever there are orders waiting there. So it's just, time zone is not really an issue in this concept. So, but because price is being subscribed, because it's being written by candlesticks which are determined by time units, then we have to go with the time units, which are the candles, the regular candles that we're looking for. So as much as the candles are higher, we see less resolution of everything, and supply and demand that derived from higher time zone, they probably would hold much more orders in it. But do mind that supply and demand works on every time frame, whether it's M1 or weekly or monthly, whatever it is. Okay, so we're about to hit this, and we'll probably see if we get a reaction in real time. Looking at M5, this is for the people who were in our previous sessions. We could see that we could have refined our decision point much higher, in about 5 pips higher than that, but we will leave it because we were drawing it by the M15, or the sorry, by the H1, right? So Sorry. So price can go all the way up to this level, to this decision right about here, which is 5 pips higher than that. So maybe that will be also our drawdown before we will get our reaction. Okay, so this is the recap about supply and demand and how we draw them. Now let's move on to the model while we wait for this to react. So moving back to the presentation. Okay, so now we have a new concept to bear in mind. Every reversal begins by breaking a level. What does that mean? The market never respects forever a level. This is why I don't like the concept of trend lines or support and resistance, because they're not unfolding enough information for where these levels are going to break. And we all know that the market is working by sometimes respecting levels and sometimes not respecting a level. So using this information and just looking at the market as it presents to you by price action, by its behavior, by action, by breaking levels, we see early signs that price has more significant power to the other side. So if we're looking to find reversals, before we jump on similar to what we're doing right now, where we just taking a blind level because it's a fresh supply, if we were truly looking for reversal, we would first want to expect that the market will give us a hint that it's going to work. What that hint will be? Breaking a level. Why breaking a level? Let's say now price is being pushed from supply, from a higher price where we are selling. We would want, before we enter the market, we want to see that price is pushing and breaking a demand before it's before we're hopping into this train. Okay. The fun stuff about the Quasimodo, about the market, especially in the Forex market, is that there is a very high probability for price to revisit levels. You would always have your second and sometimes your third chance to enter the market. So there is no reason to actually take a blind set and forget levels, because there are levels before the market had proved for you that the intention of the market participants is to actually reverse price. Okay? So just bear in mind this very simple sentence. Every reversal must begin by breaking the opposite level. Okay? So what are we looking for in terms of price pattern? We call this pattern the Quasimodo pattern. Why it is? Because it's very similar to head and shoulder. However, it has a right shoulder which is lower than the left shoulder. Okay, so that it's create an awkward type of pattern. It's unsymmetrical, and so this is why we call it the Quasimodo. And But this is the perfect confirmation. And next, we're going to look at the charts, and we will show you. And I will show you how the. Sorry, I'm being confused of what you guys are seeing. Yeah, you should see the. You should see the presentation. Okay, so this is what you see. Good. Okay, so so the beautiful thing about the Quasimodo, especially in a Forex market, is that price will be reacting to a level, and that level will prove to us that it's significant. It holds enough resistance to push price to make lower low, to break the opposite level. If this is the supply up here, from a higher high situation, it was breaking a low and creating a lower low. Okay, that will give us the hint that price has enough resistance to move further, and price will go now up and all the way to that next high, and from that we will sell. So we will have first see the reaction without participating in it, and then we will wait for price to go into a comfortable price for us to sell from. We'll take a look at this in a moment. So we have two types of Quasimodo, one for sell and one for buy. The one for sell is where price is rallying, creating a high, and then creating a low, a retracement, and then making another breakout, taking all the breakout traders and just taking their stops and breaking lower low. And once we have that lower low, we would want to sell from the high from off the left shoulder. We were not going to wait for a double top because it's not always happening. Okay, so our trade will be from the level of the left shoulder, and our stop will be above the swing of this Quasimodo formation. So that will be our entry to sell. We have also the Quasimodo for the buying direction, where price is dropping, creating a low, then retracing and making a lower low fake out. And after that fake out, it's been rejected very strongly that it actually breaks a supply. A supply in a context of price dropping should be a strong supply, right? So once price is breaking this, this is our hint. This is where the market wink at us and telling us, guys, we are looking for a new thing now, a new direction. So that trade will be, once this high was broken, the trade will be price going all the way down to the left shoulder of the low. From here, we would buy. Our stop will be below the swing, and we will buy from here and up. Okay? It's very important for us to look for the right pattern on the right place. Now we want to combine or to use confluence of two very strong patterns to increase our odds. We don't want to take any pattern or any candlestick formation as is standalone. It will not work. We need to have at least two conditions, two parameters working together. So we know that price is always moving, is always hovering from supply to demand and from demand to supply. This is from target to target. Okay, so when we are breaching for the very first time to a demand zone, a fresh demand zone, we don't need to buy the demand zone right away once price hit the zone. We can wait, see that this demand is showing us that it has enough resistance. What will that resistance proven to be? If once price hit this demand zone, it will break the supply above. Remember that the supply in the context of a down market should be a strong supply. So if we hit a demand, a key level demand zone that had made to break a supply, that just make a very simple sense that something had changed, or that in this area there is a very strong buying powers, buyer waiting to buy from the market. So price has hit target key level and it reacts with a very strong reaction that hints for us that price is want to reverse. So the Quasimodo, the confirmation, is giving us the second chance, and we don't have to take the risk just buying a blind demand, because we have now a confirmation. Okay, and like I said, in Forex especially, price tend to test levels over and over. So we will have we have the demand zone waiting for us, and we're waiting for the approach, and then we see price hitting the demand zone. We're not yet in the market, we're still observing, and now we're waiting for trigger number 2. Trigger number 2 is that demand zone is reacting and a supply above is being broken. Now we know that we want to buy. Where we want to buy? We want to buy at the left shoulder of the Quasimodo. Okay, and our stop will be just below that swing. That will keep us safe enough for that reversal. We see the hint that price is going to reverse, and we have the second chance to get inside. That is the confirmation. Same confirmation for the sell. If price is coming from below, hitting a fresh supply zone, creating a fake presentation of wanting to go up, but then it creates a lower low. We know that this supply has enough supply resistance, enough supply sellers that are waiting here, because we see price is breaking a demand at the context of a rally. When we see that, we can, the simple logic for us to understand is that something had changed, where price is always rising, making higher lows, and making new records. Now it hits a fresh supply where we assume that they're going to be resistance, but now we see how strong the resistance is by seeing for the fact that price had broken demand at the context of buying. So we know these are a less issue now, are less strong at this moment. So this would be our hands where we want to sell. Once price returns to the level of the left shoulder of the Quasimodo, our stop will be just above the swing, and from here we can sell for a reversal trial. If we want to be more conservative, we can leave our stop just above the full zone and just use this, and this will save us few stop outs, but this can refine our risk to provide us better risk ratio, but sometimes we'll just be caught with the stop outs. So this is the Quasimodo. Okay, I've been asked if a Quasimodo is a common name among traders or is just my own strategy. A Quasimodo is a rather new name, but it's there's extensive community that use the Quasimodo because of a few leaders that were actually referring to this pattern as Quasimodo and not as fake out or and hover and beyond, all sort of these names. The Quasimodo is, if you search Quasimodo, you'll find some information about this and more tutorials about this. So how does the Quasimodo look? We're looking at the Quasimodo. We're looking at the Quasimodo in a very clean laboratory sketch. This is how it's look in real on chart. What is it we see? We see price is rising up, a retracement on a buying context, and then price is faking out and dropping down. So the Quasimodo will be at the left shoulder right here. Sorry, Quasimodo will be at the left shoulder right here, and price, when it comes for the first time, we will expect to see the Quasimodo in action. Okay, so the first time was actually not in here. It was much before. We see that price had broken that demand right here, going all the way up to the Quasimodo level, penetrating with few pips and then going down. So that of itself have taken that Quasimodo way before price here. So this is a reaction for a different price action. So we do have a supply demand right here above, and then price is rolling up, retracing, going up, reacting on a first supply, and that first supply results with a very strong movement that breaks demand in the context of a rally market. So that of itself tells us that this zone is very, very strong. So where would we want to place our trade in the future? Right about the left shoulder of the Quasimodo. Our stop can be above the swing, or if we're more conservative, it can be above the whole supply zone. So we are going to wait for price to approach this level to sell from here. So you see that we are watching from the sidelines on the reaction on the supply. We don't have to take risk, and we already have the hint that price is going to react on this. So this will be our confirmation. So now let's take let's go to the charts. Share. Okay. Now, it's a recap from our trade from the beginning of this session. We see price has went to our supply and it's reacted, giving us 2.5 pips reaction, and it gone since it went there. It gave 25 pips a 25 pips low, and now it continued to go down. So here you can see a supply that we've done in real time, reacting in real time. So here's our proof for supply working in real. Okay, let's just take this, close that trade, because we cannot know, we didn't really done enough work about the target. So that's just to show you the demand. Okay, the supply that had just worked. Now, so very similar to what we've seen now before. Now we have a first supply, and price is approaching for the very first time, is approaching a first supply and reacting to this supply zone. So now, once we've seen that, we would like to, I was thinking that I think it was completed already, but I've marked it before. So we have that supply zone drawn by the H1, and now we go to M15. Okay, it's all real time, right? And we see price is reacting to the supply, creating a lower low. If we were just blindly selling this, then we were taking about 10 pips drawdown in this trade. But we also have we said that we want to look for a confirmation before we want to sell that first supply. So it's not really so we move to lower time frame, so we have a clearer view of what happening. So we have a buying pattern where we see higher lows, and breaking highs, and then we finally have made it to the first supply, where we expect a reaction in it. So now we're penetrated that supply and it reacts, but now we want to have a confirmation to sell. So the last swing before price had reversed and show us was that it reacts to this first supply. It was this high and lower. Let's move to M1. Okay, so the last swing was pricing making this high and then racing for a while, and then break out and fake out, right? So that fake out had broken this demand in the context of strong demand. So that tells us for the very first time that price is no longer in the hands of the buyers, and sellers are starting to take over. We don't know yet that for sure. We know that once price is breaking the demands, and it breaking more demands, and now it's being reacting to this demand. So now, next time price is going on this left shoulder, we want to sell. So price is making a lower swing right here, and we set our limit order, and this is just minutes ago. It happened after we opened the session. So we are going to sell at this Quasimodo level. Our stop will be just here above the swing, which is 7-8 pips. not including spreads. And we were selling from here, and now we've made, it made a 16 pips reaction already. Okay, so if we were to scalp this, this is showing you that this have already made some significance. So this is one Quasimodo that we can see how it reacted in real time. So we see price in a buying context, making higher highs, making higher lows, and then finally making a fake out on a fresh supply. On a fresh supply, and then breaking demand. Remember that sentence. Every reversal must start by breaking the opposite level. So if we're buying and we're hitting supply, and now supply is regaining power, that must be resulted by breaking demand. So here's a demand broken, here's another demand broken, here's a demand respected. So as much as we want to have this trade to be a reversal, we cannot know for sure price will this demand. Let's mark this one. Okay, this demand is not yet been broken. It was respected, so we respect this as well. So we cannot have our target lower than this demand just yet. Okay, so our target should be around this demand here for now. So if we still hoping for reversal, we can take a partial here or move our stop from our entry and let price maybe go lower low and give us. But the best and safe thing to do is to take our profit right on this above this demand right here, because it had proven to hold price yet. Okay, so this is how we trade a model that I've marked before. Here's another example of Quasimodo. And again, it's very, very important to understand what is price reacting for. Okay, so let's just take this. So we have this base right here. Let me find it for you. Okay, that's right here. Okay, now I'm 15. Anyway, it's a flag, it's a base that was made here. That explains, okay? It doesn't mean that we would actually want to buy this level, but we see this level reacting, and then we try to understand what happened in the past. So we see that facing, we see this flag right here, and this is what holds price. Sometimes we can only understand this on the hindsight, okay? But it's a fact that price had reacted to this one. So if price reacted to this one and now is creating a Quasimodo, we have a very obvious downside, okay? We have a very obvious drop, and it comes to a demand, and we don't know how much power there is in this demand, but it's a fresh demand. And now we look at price and we see that price is to this, and breaking supply in the context of a sell-only market. Okay, this supply right here. Sorry. We have this supply in the context of drop, okay, which was broken. So what was, so this is the fake out. Sellers were thinking that they are breaking the swing low and they can sell. And what happened? Price is turning against them. Okay, all these breakout sellers were caught now, and they are suffering with the agony of drawdown. And we see that there is a reason why price would bounce here. It's a fresh demand. And therefore, we see there is a very strong demand right here. Okay, and that strong demand had broken supply. So we would have a Quasimodo level right here on the left shoulder. And see what had happened once price returned to this. If we would buy the first time the market hit the left shoulder of the Quasimodo, okay, because the Quasimodo has made this. Let's have it on. Okay, the Quasimodo made this. And now it was, now this level is what we want to buy, okay? We have a demand, explain demand, although we explain it on the hindsight, but it's explained, it's reasoned. Now we have the left shoulder, which signal us where we want to buy. And then when price coming for the very first time, we buy from here. We got 6.6 pips drawdown and 54 pips reaction to take. And it's not yet over. Okay, so this is how the Quasimodo works in action. So that's a buy Quasimodo example. Which time frame? Time frame, again, is not an issue where you are looking at price. Price is price, and the swing highs, you can see them at any time frame. Okay, this is where there was a deal in the market. So you would see this, if you see it on H1, you would see it on M30, M15, M5, M1, maybe H4 if it's not washed. Price is price. We can see the swings, we can see the retracements, we can see the reversal, we can see everything, and that will create our price pattern or price action patterns where we want to buy from. So if you're asking what would be my favorite time frame for intraday trading, I would be looking for the levels where I can see them with my naked eye from H1 and up. Will create these levels. And once price is hitting these levels, because I consider them more stronger levels, more than the swing levels of H1 and up, these are key levels in my understanding. And then I would go to M15, M5, M1 to see the reaction, and with that reaction, I would time in my entries. But again, it doesn't important that the M1 or the M5 would just give me better resolution and faster conviction and micro movements or micro patterns that I can see early signs that that something is changing in the market. Okay, so it's always start with higher time frame. I like H1 and daily, and my entries will be based on M15 and lower. Okay, so that's another Quasimodo on the CAD yen. Euro US dollar. Here's a Quasimodo that wasn't happening yet. Okay, so we have a demand, a supply right up on top, and price is approaching to this supply and reacting. The way it reacts with a double top, it reacts and break the last demand swing right here, and continue to make lower lows. So if we have a reason for why price is returning, then we can consider this Quasimodo pattern valid for our trade. So the last swing before the fake out was this level. So this level is going to wait for us until price will come, even if it takes longer time than immediately. It doesn't really have to be very, very near. Once price is coming here, there are supply orders waiting to be executed at this level for how long it's going to take. Okay, when I was trading Quasimodo, sometimes I would make 100 pips. I remember one trade on a Euro Yen a few years back. It gave me 178 pips profit with a Quasimodo formation that was a year before the markets actually went back there. So it can work on any time frame. So the Quasimodo can be expanded like an accordion, very, very wide, or it can be very, very fast. But it's only the first reaction. When the first reaction, whenever it happens, the price is timeless. Okay, there is no time validity for key price. If that price action is clear, never been visited or tested before, it's going to give you good probability to work. Because if you look at price and you see all these spikes and all these turns, there are reasons for this. It's not just happening from out of the blue. It has a reason. There is a logic to the market. The market is not noise. If you see this spike, this rejection was caused because of something. Because of what? Only because of the imbalance from buyers to sellers, the imbalance from buying orders, the demanders, to the sellers, to the supply. So that is why price is being rejected. Of course, in less liquidity markets, there will be players that can manipulate price by injecting more orders, but it always be pushing price by injecting orders into the market. So it's actually the fuel to how price moves is to play with the balance of supply and demand. This is why it's timeless. Okay, so every spike you see here, there is a reason for. And if you go to the micro level, to the micro charts, the M1, even the tick charts, you would see a flag, you would see a turning point, and that would explain why you see this rejection. So all these rejections are happening for a reason. If you agree to that, you always going to, every time you see a swing, when I was trading, I would always have two lines, one for the very low and one for the very high. And I would always go and try to explain if it hits something on the left, on the history. And if I see it react to something significant, I would wait for my confirmation price action to join that that event. If it's not significant, like now, we see this spike, although it gives 13, 15 pips, it's not yet significant. So I don't have my higher probability to look for something, okay? But sometimes, surprisingly, price can do a deep retracement or a deep reaction to levels that you would not consider them key levels. But when we are to analyze supply and demand, we're just assuming that that we will have enough buyers or sellers in this area, but we never know amounts. We never know how many are there for sure. This is why we only trade first reaction, clear reaction, and we don't know for sure how powerful would that level be. This is why we would want to use higher time frame key levels and try to work only at the extremes and not on the mid-range base and drop levels, because these might be washed out by news or by different events that we're not aware of. We don't know how these levels would hold. So our best way to measure risk is to go for the extremes, levels, and then we will go to lower time frame, look for our price action confirmation in terms of Quasimodo, and that will give us better odds to be successful in the long run of trading. Okay, questions. Do we only trade to supply or demand zones? It's a good question. We don't, unless you are a swing trader, then you would have to consider more risk management ways to hold on your trade. I'm a person with less patience, so I prefer to scalp. So I would wait for price to hit key levels, and I would just scalp a few pips out of it. I take 15 to 20 pips on a scalp, and that would satisfy me. Taking many of these will accumulate enough for this. I would not risk taking hundreds and dozens pips per trade. That will just not be in my book. But if you really want to swing trade, then you would have to have enough patience to let price go down, retrace anew, crawl all these ways until it hit the targets. But if you go and start evaluate historically supply and demand, mark supply, mark demand, and see how price is reacting when price is breaking levels, you would see that price is really respecting supply and demand levels, and you can make nice swings out of them. There's another method using the supply and demand knowledge is when you see a trending market, then every time the market had decided to move higher, you would mark a demand and wait for price to deep retrace back to this. So here, price had made it to this demand, to this decision, and continue. Then there's another decision right here. So price had returned here, but now on this demand, price has not came back yet. Okay, so with this, you can just enter and see how price is reacting to demand on a rally bias market. If of course, if the market is dropping, it's pretty much the same on the supply demand. So if you use your common sense and use a great amount of logic, then you can use this knowledge to have a better odds for succeeding, for taking your trades. On the ranging market, you can have good probability for price to react on that streams for several times. But then again, you should have a good definition for what is a ranging market and what is the range. Okay, but we can see that price is ranging on this, and there are different few touches on this demand that you can just take in, and you can decide if you want to take it from the demand back to the supply and back to the demand and back to the supply. You can decide whatever you do, but you really have to back test this and see and measure what are your odds to succeed with this. But the supply and demand is just a knowledge that you can apply with everything. Okay, so you need to have a good idea of what you want to achieve with it. Okay, but you can see that supply and demand really works and being appreciated. Here's a nice supply with good reaction right here, and another reaction here. Here's another supply, and now market starting shifting up, and yet it's responding. Okay, here's demand right here, and price is being held by demand, and another decision point right here, which is a bit lower. So we can't say it's a reaction to this, but you get the idea. If you go and investigate how price move from supply and demand, then you would have a good idea of how to use supply and demand for swing trading. Which candle would you recommend is best to get in on? Rami asked. I'm not a great fan of candlestick formations. I'm looking at price, and I'm looking at what price achieved. Okay, if you, I promise you, Rami, that if you would learn how to read price by the achievement, and then you would take, let's say, you see a price action that had made achievement. We see here that price is very choppy, right? Maybe if we take this whole area and we consolidate this into a daily or a H1 candle, that will be a hammer. Who knows? Okay, so would you rather understand what is price doing, or you just want to have a Japanese name for it? I prefer to understand what price is doing, and price is doing, and if you learn the candlestick patterns rule book, you just take it as somebody else understood it and back tested it. But if you look at what is price achieved by supply and demand, by making, it's very simple. If we have a demand that breaking supply, it's all we need to understand in the market, right? If this demand was never visited before, we can assume that it's going to create a reaction. I don't care if it's a pin bar, if it's a hammer, if it's a doji, or whatever, harami, whatever Japanese name you will call it. It doesn't, I don't care. It's price doing this. And if I break down this pin bar, maybe I'll find more patterns inside this pin bar. So I don't really care about this. I care about what price was making, what level were broken, and what does it say to me in terms of the balance forces of the buyers and sellers. So this is how I simplify things for myself. How do I decide where is the decision point? I recap this. The decision point is very easy to spot. We see a rally. You see a rally, right? So where is that candle that had started that rally? I would say it's this candle. And this candle, and where is the base before that rally? It's right here. Okay, so for me, the decision point will be after that. Let's make it bigger. Okay, we see price is going up and down, and after that, price was very decisive going up, right? So that decision point will be, I would make it here. Okay, you can also be conservative. Now I'm going to confuse you maybe, but just so you know, price had to be breaking this micro supply up here. So this one can also hold price as a decision point. So if you want to have your entry with greater assurance, then you can set your buy on here. That will be more conservative, but the drawback for this, that you might suffer deeper drawdown and spend some times in drawdown. If you want to be more precise, try to use this neck, I call it a neck decision point. And if you want to be more precise, go to a very deep, very low time frame, and maybe you can refine this even harder. The drawback for this is that sometimes you would miss your trades. So be prepared that you're going to miss some trades, and just don't take trades that you've missed. It's one of the FOMO rules that you should not be playing with. It can be devastating to your statistics and to your trading. So whatever you decide, you trade only the levels that you decide on, and you have to know the drawbacks and the advantages of each way that you control. But it's very obvious to see where price had made a decision, and the origin of that decision is right about you. It's only about making sense. Okay. So what is the difference between supply and demand and support and resistance? We get these questions every session, and I'm happy to answer this every session. Supply and demand is where we analyze where we can find buyers and sellers resistance in the market that will result a reaction. Support and resistance is you can draw support and resistance only after you see that price had reacted to a specific level more than twice. Okay, only after twice you know that you have support and resistance. But understanding supply and demand, you know that after the first touch on a fresh supply or a fresh demand, you can no longer have a good assessment of how much resistance force you have on that zone. So you cannot know if that um, level will hold with supports and resistance, because you don't have this information unfolded in this concept of support and resistance, while in supply and demand you do, because this is what you're looking for. You're looking for a decision point, and that decision point is by logic, where there are unfilled orders waiting to be executed in the future, while in support and resistance, they were already being tested before, and you don't have the information or the concept that's telling you that these levels are no longer valid. Supply and demand will give you that information. The second thing is support and resistance are just a one-dimensional line. They don't give you the full trade um, plan. So with supply and demand, you would have the full price action zone, where you know what is the swing that you're going to risk, and where is your entry, and how much points you should be risking in terms of price action. So that also gives you information that is not available for support and resistance. So I think support and resistance are just coming from the opposite concept of understanding the market. So you can only see these working after they've been working. So it's a lagging um, information, while supply and demand is you have the information and you're going to react on this when it's really where it's still valid. So these are my ideas about the two concepts. Which tools can be used along with price and action? Jitendra, I don't really understand your question. Which tools can be used along with price action? I read it twice. I'm not sure I understand the question. Please rephrase. In my trading history, I've never waited to hit my take profit. I always scalp alone. Is it all right for a trader? Israel Awari is asking, he's saying that he's not using a hard take profit, is if it's okay. Yes, it is okay, as long as you know how to live with it, and as long as you are retaining a good profitability. If that works for you, applause. If it doesn't work for you in terms of how much you risk and how much you take, and you don't have a good risk reward profit factor, then you should work on something. It's very important. I think supply and demand will give you a good estimation for what targets can be, and maybe you can add this information into your trade profile and then decide if you take that trade, yes or no. That can help you out, I think. So if you look for how to time how to take your trade, then that would be maybe some beneficial for you. But if it works for you without defining a take profit, that's also good, as long as you maintain a good profit ratio. How do you decide a decision point? I think I've answered this. You're taking signal in H1 plus time frame for enter and exit. If we wait for price to revisit Quasimodo level, we can take only few trades a day. Okay, Okay, so it's a long question to say to ask how many signals we can have this in a day. I can tell you that you can have tens of signals if you only. I trade only majors Forex pairs and their combinations. So I have like 28 different assets I trade, and I can have within one session I can have 5, 4, 6 signals, and if I can go any further, I can have more. Do mind that it's not always waiting for the extremes. You can add to your toolbox methods that are related to supply and demand. It doesn't have to be at the extremes. You can trade the flag and poles. You can look up for consolidate compression activity like we've seen in the last session, and that will give you more patterns to use. So adding up more tools and more concepts that are related to price action, to order flow and supply and demand, you can have enough trades ideas. And it's also related to how much you expect to take from a trade. If I expect to take from a trade 15 pips, I can have at least 10 signals a day for that in terms of supply and demand based on H1 charts. What time frame? Okay, a few more questions. Do you trade algorithmically or manually? I trade manually. I think algorithms, there's so much discretion, human discretion and understanding and variables that you should consider, and the amount of learning that you have to invest in trading and learn and relearn all of the time is something that writing the proper code is not processed fast enough. Of course, you can have very highly sophisticated algorithm, but it would work for a while, and then you will have to redefine it. I can tell you from my experience, I used to write code for MQL, and I used to, and then at one point I realized that once you have a strategy written, then you have to continue work always assessing if that algorithm work and valid on that market. So you practically doing the same work over and over. You never set and forget an algo robot in a market. You always have to work for it, monitor for it, refine the code, look up for different market situations that are not covered. Market do change, so you have to modify. So you practically do the same, but you do automation. So there's no 100% automation. Maybe there are some shortcuts that you can do with algorithm, but you never do. You never have 100% where you just set a robot and go live your life happily without reviewing this over and over. So the same work that you invest in coding, recoding, reassessing the market, learning the market, why not just placing the trades manually, experience the market from very, very close and very, very with a human observation, and just act with a common sense. The human ideas and problem solving is much faster than having a full process of recoding and do everything. like this. So, so I don't algorithm. The supply and demand strategy alone is sufficient. Yes, I use supply and demand with price action, but supply and demand is only telling me the story. Supply and demand is a concept, but it's not just a strategy. It's just a way of reading charts and give you some conclusions. But on top of this, you have to be trader. You have to put your risk management. You have to have your trading, your trade profile very solid and aligned, and you have to be very disciplined. Everything should be there. There are no shortcuts to this. So you can. I know a lot of traders that simply but they have to develop themselves also as traders. It's not a trading. It's a reading. It's a reading concept. Is it necessary to check larger time frame also in trading for lower time frame for a long position? Yes. Like I said before, in my concept, price is price. It doesn't have time frame. So the time frame always give us the opportunity, like a microscope, seeing the same thing but with in different resolutions. So because this is the only way market writes itself graphically, we really have to toggle between all the time frame to always look and see for more information that cannot be seen sometimes in lower time frame or sometimes in higher time frame still. So if you have the full picture, you have to drill in and drill out and get yourself the full story, the micro and the micro. How does the system fare during news with big spikes? Like if there's news goes through our decision point. Okay, it's a very good question. How a supply and demand react to a very high liquidity events like news. So first, I'll give you a homework and a drill. Go and mark supply and demand levels on H1, H4, D1, and then go to the economic calendar and be there in real time on demo and see how price reacts to these levels. So what will happen if the level is very near to the market price and you come alone? Maybe that level will be reacting very fast and react and reject price, and maybe price will be washed up. Why is that? Because when a lot of liquidity comes into the market, remember that if you remember that simulation that we're doing, that we have this table at the exchange and we have a certain amount of buy orders and a certain amount of sell orders for the same price level. What happens if there's a huge amount of orders coming all of a sudden? That would wash out the net balance between buyers and sellers of that level, right? So that will wash out your level as well. So if the level is rather far away, you can be safe that price maybe will give a very, very long spike, hit your level, react to that very, very precisely, and reject and give you a lot of tips very, very fast. But if price is very nearby, I think you better cancel that order and don't let the market overrun you. The news, usually the market participants are waiting for the news to break levels, because the market is always about breaking levels, testing and then breaking levels. It's part of the nature of the market. So during news, because of the high liquidity, levels will be broken. So if it's too nearby, you don't have a chance against massive amounts of orders that's coming on these hours. So you better get out. But if it's like 60 pips away, sometimes you will be rewarded very fast by getting your trade in. We need to combine order flow analysis and price action with supply and demand too. Another question is if a price action and order flow and supply analysis should go together. Is it a must? No, but I think as much as you understand the market by price action and what is price action is reading out for you, with supply and demand as determining the key levels, that these are two things that I find that are complementary to each other, and that helps for me to create higher probability trades. If I think supply and demand can be useful in instruments with low volume because of manipulation. The lower the liquidity is for an asset, then it's more, the more chances somebody will take advantage of this sometimes. Most of us are retail traders, and we don't have that tools of bigger pockets in the market where they can actually create action in the market. Whatever we do, we're not creating. We can only join. So understanding your position in the market, find the right trading profile that suits your pockets. And I would say lower liquidity assets are not one of them in my book, at least. With this session be recorded? Yes, it is. Okay, guys, we're almost an hour and 40 minutes in, and I see people are losing patience. We were like about 200 people before, and now we're only 80. So that tells us it's a good time to end the session. So I thank you so much for coming. Next week, Tuesday, is our last session, supply and demand, and we will going to wrap everything together. I will give you some broad thumb rules, ideas of how to assess good trades and bad trades. So we're going to wrap everything. If you do have questions, save it for next session. You can send it to us before the session begins, so we can prepare ourselves, giving more elaborated answers for you with more samples. So thank you so much for joining up today. Next week, same time, is our last and wrapping session. Thank you for showing up. Thank you for bearing with me for so long, an hour and 40 minutes. See you next week, and thank you. Bye-bye.